Good morning, and thanks so much for joining us here on Aspire to Retire with Ralph and Tim Short of Welcome Home Financial Partners. WelcomeHomeFP.com is the website if you want to find out more about Ralph, Tim, the entire team at Welcome Home Financial Partners. That's the website, WelcomeHomeFP.com. The phone number, if you have questions about things we talk about today, questions about your retirement in general, just want to know more, set up that complimentary, no cost, no obligation time to come in and speak with them. It's 804-635-3550. Once again, 804-635-3550 and online, welcomehomefp.com. My name is Chris Swan, and I'm pleased to be joined by the father-son team behind Welcome Home Financial Partners, as I am every week. Ralph, Tim, glad to be with you. How are you today?
Doing great.
Doing good, sir. How are you?
Doing well. You know, excited for, we're going to talk about this in a second. I know from a team standpoint, the spectacle that's going on this evening with the Super Bowl is not something that we're going to be, what's the method? What's the thing? I hope both teams lose. I've heard that said a few times here, but we're going to talk about that. But appreciate you guys taking time out of your schedule to spend with the listeners here as, you know, they get ready to enter on this next great chapter known as retirement. Let's go ahead and dive into it because it's the talk of everywhere. You know, you go to the grocery store, you go turn on, you know, sports channels. The Chiefs face the Eagles in the Super Bowl tonight in New Orleans. Win or lose, the players, they're actually going to get a big bonus. Members of the winning team are going to get $171,000 each, while the losers, you know, they don't walk away empty-handed. They're going to receive $96,000. So if you add in all of the winners' playoff bonuses to the pot, what they've amassed so far, each player is going to get $357,000 regardless. It's not a bad windfall. You know, some of our listeners, they might be getting a big chunk of money from a work bonus, perhaps an inheritance or some other source, and they might get tempted to spend that on an impulse purchase. How would you handle a large unexpected gift, and what are some options that people might not consider?
Well, before we get to the task at hand, let's talk about my Washington Commanders, who I believe should have handled the Eagles. But I don't know about you, Chris, and I know I speak for a lot of folks. Number one, we're not excited to see Taylor Swift every commercial break, but we also are getting tired of the same teams winning over and over again. So, yes, I would prefer for the Super Bowl to end in a tie.
Yeah.
But yeah, we'll see how it goes. So anyways, my Washington Commanders are on the uprise. So I just wanted to throw that little plug in there. So when it comes to actually getting a nice windfall, you know, there's a lot of people, especially, you know, what we've seen this past week with the federal deadline of February 6th. And there's a lot of decisions for some of these government employees to make, you know, whether they take, you know, lump sums of their pensions, various different things. You've got some opportunities to pay down some high interest debt. There's different things that you need to take a look at because most people, they're not, as they're working, they're not anticipating a large bonus or windfall or, you know, pension buyout or what have you. There are some things that you need to probably change for your retirement plan. If you've got debt, I worked with somebody this week who called me on Tuesday, and he was a federal employee and said, hey, I know I only have 3 days, but, you know, these are some options that I've got. What do you think? So it's not very good to put things on the back burner or put yourself on a time clock because life happens and things change constantly. So, you know, if you've got the high interest debt like he did, we talked about his mortgage, so you can address those issues. But also it's really important to reevaluate your retirement plan because maybe you can take a large sum of money and do some investing that you didn't anticipate before. So you've got some options there. I don't think any of us here sitting at the table are going to get $357,000 for playing a game for a few weekends.
Probably not.
But,
no.
you know, there are some opportunities out there.
So one of the things I always talk to people about is, you know, if you are going to get an inheritance, what kind of type of money are you going to inherit? I'm not talking about the value of the account. I'm talking about what type of an account is it? Because if you inherit an IRA from your parents or something like that, it depends on whether it's a Roth or whether it's a traditional IRA as to what you can do with it. And then that kind of determines what you need to do with it. Because if you have an inherited IRA because you're not a spouse that gets it, you're going to be required under current tax law. And we always have to say that because the government's always changing their mind about how they want to tax it.
Yes, they are.
Now more than ever.
So you have to kind of keep in mind the qualification of that program. And what I mean by that, if it's an IRA, then you inherit it, you need to have it liquidated within 10 years. A lot of people don't realize that's part of the situation when you have that. If you have qualified that's one thing. If it's non-qualified, which means it's not a retirement account, you can kind of do what you want to with it. But it all depends on you and your situation and what it is that you're trying to accomplish. Yeah, paying off high interest debt like credit cards, that would be top priority for me to make a recommendation. But to pay a mortgage off, and that's a different question, because if you're lucky enough in the last 4 or 5 years to have accumulated a mortgage that's only charging you 2 or 3% interest, it really doesn't make a lot of sense to pay it off, other than emotionally that might make you feel better, but financially doesn't make a lot of sense. So, and you always have to understand that you need to have some liquidity in all your investments, whether it's in a bank or whether it's in a money market account, anything like that, because you never know what life's going to throw at you. And you might need some money all of a sudden because you had a medical emergency with your grandchild, and all of a sudden they needed some help to pay that medical bill off, even though they had medical insurance. So, it all depends on the individual. It's not a template for anybody, in my opinion. I mean, I know that we looked at $357,000 is a lot of money for most people, but to the average athlete, that's just a drop in the bucket for what they've been making. And how come a lot of these athletes professionally end up broke within a few years? Because they forget how to manage money, because they think it's always going to be there for them. And that's one of the things I always kind of talk to people about. You just never know. And estate planning is a big issue for a lot of these guys.
Well, I think, I don't know if they forgot how to manage money or they just never knew how to do it from the beginning. And I think, not to beat up on professional athletes, but there's not a whole lot of education out there when it comes to finance and retirement and investing. Because, you can make $10 million in a year. You blow your knees out, guess what? You no longer have a job because you can't perform. Now, is that $10 million going to be able to last you? Because what's the first purchase that everybody buys when they're a professional athlete?
Car or house or something,
or a ridiculous car that's probably costs more than my house, right? So that's a big issue for them. But, when it comes to, Ralph brought up a really good point of, what type of money are you inheriting, right? If it's after tax money, if it's just stocks, well, you're probably going to get a step up in basis unless they change those tax laws. So there's a lot of things that you have to pay attention to. So if you do get a large windfall, it might not all be yours, right? So it might be partly Uncle Sam. So it's important to pay attention to that.
But again, making sure that your money works as efficiently for you as possible. And that means more often than not, giving as little to Uncle Sam as possible with a proper plan. That does take, I think, a little bit of pre-planning on behalf of, especially in the case of an inheritance, on the person that is leaving the money behind. But again, if you come into a windfall, sure, it's fun to think what that could buy as far as big ticket, but you want to think big picture, honestly. And as you said, paying down high interest debt, things like that, is something that in the long run could be pretty fruitful and beneficial. So yeah, I don't think anyone here, I think our playing days are over if they ever really began. Probably not going to make those large figures. And I'm with you, Tim. I was hoping for something like a Bills Commanders, just to make it a little bit different. But
that would have worked for me for sure.
Yeah, I have no doubt. But whatever it is, when it comes to any windfalls that you're going to be getting, a pension buyout, an inheritance, and you want to figure out how to make it work as efficiently for you, having a conversation with a team like Welcome Home Financial Partners. They can help you, look at the pros and the cons, and not going to tell you how to spend your money, but show you, the cost behind it and the value of that dollar. But it all starts with that phone call, 804-635-3550, or going to the website. You can always go to the website, always available online at welcomehomefp.com. Now, for most of us who aren't getting signing bonuses or, playoff bonuses, things like that, our money is tied largely into the stock market and investment accounts, things like that. The 60-40 portfolio, 60% stocks, 40% bonds, has been the most popular type of portfolio. It did take a big hit in 2022 due to bonds really underperforming and the stock market taking a dip as well. But it is up 15% 2 years in a row. So it's back. Maybe. What can we expect from the portfolio in 2025? Here's Jason Kephart with Morningstar.
I think you always want to keep a longer mindset with a 60-40 portfolio. In 2008, it lost more than 30%. 2022 was down almost 20%. So this is not a one-year investment. This should be like 5 to 10 years minimum time frame. But having said that, yes, stocks are more expensive now than they were a year ago. Bond yields are starting to come down. So you might want to check your expectations a little bit, and another 15% plus return might not be in the cards, but then it might. But there are some risks, I think, that are really pertinent to kind of investors keep in mind in 2025.
So you did say longer mindset, and for retirees and pre-retirees, you know, that may not necessarily be something that they've got the stomach for or the time horizon for. So what do you think about what Jason said? Do you recommend a 60-40 portfolio, or do you go with some sort of allocation?
Well, I think there's different ways of going about it, right? A 60-40 portfolio is pretty much just a boilerplate, if you will. If you take a look at it, like you say, this is going to take years, right? Some people don't have years. Yeah. Especially if you're in retirement or near in retirement, you know, you take a big hit. 2022 was a pretty bad year, but this kind of sounds like a double-edged sword, because if stocks are overvalued and bond yields are going down, then where do we go, right? So, you know, as you're approaching retirement, there are other avenues to take a look at. There's more things in the investment universe, if you will, than just your stock and bond allocation. And I think that's what's more important. Is most people, you know, they kind of get into bonds because they're concerned about the stock market. So you want to have a little bit of a diversification, a little bit of a mix there. But as 2022 pointed out, bonds aren't the safe investment that people think. So there are other avenues that you can place money where you can avoid some of the market risk, maybe all the market risk. But I think that's what's more important, is have a tailor-made plan to you, and not just, okay, hey, you know, you're 60 years old, we're going to do a 60-40 split, right? And I think that's where a lot of advisors get it wrong, because that's the rule of thumb that they use, and rules of thumb aren't necessarily great for everybody.
Right.
Yep. And one of the things that we always sit down and talk to people about, and, you know, when they ask that question, how should I invest? How should I do this? How should I do that? And, you know, my standard answer is, it depends. It depends on what you want to do, how you want to do some things. And he was correct in that most people need to take a longer term time horizon for most of your stocks and bond portfolios. If you feel like you need money out of those accounts to pay your mortgage and bills and things like that, may not be the best place to put all your money, because in case it does take a hit, I mean, like in 2008, if you had $500,000 and it lost 50% that year and you're fixing to retire, how's that going to make you feel? Because you just lost $250,000 that you were dependent upon to get your income to pay all your bills and do the things that you've always dreamed of. So, like I say, it depends. You need to have some of your money into bonds and stocks probably, but do you want all of it when you're fixing to retire? If you're 20-some years old, 30 years old, hey, that's a good deal, because most of that investment dollars is probably going to your 401k. You can't get to anyway without penalties. So let's not even worry about it at that point in time. But as you get closer to retiring or in retirement, because that's where a lot of people say, well, I'm already retired, I don't need to look at my plan, I've already got it set. Well, how do you know that? Most people really don't have a plan. They just have an investment statement. And that's what we do when we sit down with people, is we go through our roadmap process and say, how much do you really need to come to you in your retirement? Have you done a good job of saving towards your goals? Have you done what is your pension going to be like if you're lucky enough to have a pension? And what's your Social Security? When are you going to take it? Those are all dependent upon a retirement income plan that we go over with our people when we sit down with them for our roadmap process, because it all depends. If you've got enough money coming in from a pension and Social Security to pay your bills, then guess what? You're in high cotton, because all of a sudden everything's going to look lovely to you, because you don't have to worry about whether the market is going up and down under normal circumstance. There's always going to be those obstacles that in life that's going to throw your way, because all of a sudden you had a medical emergency that you didn't have any knowledge of that when you started retiring, and now it's going to cost you. I'll give you a perfect example. Just the other week when we were at a conference, we both caught type A flu and came back, and the doctor prescribed a pill for me. And he said, it's one pill and it's going to do you good. It's just going to cost you a little bit of money, And I said, okay, that's fine. So I went to pharmacy, and after 4 pharmacies trying to find it, and that one pill was $250. So just people, you just don't imagine things like that, because years ago, if you would have told me when I'm starting out in 20s that I'm paying more for a vehicle than I did for my first house, I would have thought you'd be crazy. But that's what's happened in my lifetime. When a house, a 3-bedroom, 2-bath house, we're into $70,000, and now that same house, depending upon where you live, is probably going to run you around $500,000 right now. But our cars are around $75,000, $80,000 for most things.
Figuring out, obviously, that is an important factor, the growth potential, the fact that things do cost more and more, even if inflation has, quote unquote, cooled down a little bit. It's debatable, right? But it does mean that things are still going up in price. The buying power of your dollar is going to diminish. So I think astute listeners, longtime listeners will know, we said just last week even, there is money in your accounts that you do want to think like a younger investor, big picture. That is true. But for the more immediacy, you want to make sure that is not subject to the whims of the market or, bond rates, having something that is guaranteed that is going to come in, Social Security, a pension, annuities perhaps as a vehicle to provide that stable income. And then for the rest of it, if those expenditures are covered alone by that guaranteed income, yes, you can have that money in the market for that growth potential down the line. But finding that right blend, it's going to depend from person to person. Obviously, their risk tolerance, what they need the money for, what their budget is going to look like in retirement. There's that B word that so many people don't like using, of course. But it is important to know, how are you going to get to, through, and beyond retirement? It's part of that roadmap process, and it's part of the conversation that they have when you set up that complimentary time to speak with Ralph and Tim, the team at Welcome Home Financial Partners. That starts by reaching out right now, 804-635-3550. As a reminder, this is a no-cost, no obligation appointment with them, 804-635-3550, or go into the website, welcomehomefp.com. We were talking about the 60-40 allocation earlier and, people having money in 401ks. I said this countless times, but it bears repeating. Retirement accounts are not retirement plans. There's a big difference there. But let's talk about 401ks and the stock market in general right now, because the tech sector has been the darling of Wall Street as of late, thanks to AI, artificial intelligence. Companies like NVIDIA have helped prop up the S&P 500, the Magnificent Seven stocks. I think you've probably heard of those being referred to before. The party was spoiled recently, however, when a Chinese AI startup called DeepSeek came out of nowhere. And just like that, NASDAQ dropped 600 points. Now, it took its lumps, for a couple days. It did recover slowly but surely, but it bears the question, I think, is AI too volatile? Here's asset manager Kevin Mon on Fox Business.
AI isn't dead. In fact, I still claim that we're just in batting practice of a doubleheader. So this is a long road and a long path forward. And those companies that aren't investing in AI now are likely to be the losers down the road.
But I think all this does raise the question, is someone's 401k, are they as a whole becoming tech funds? How do you find out what people's holdings are? And if necessary, how do you guys help diversify them?
Well, I think no matter what sector of the market you're talking about, there's always going to be some volatility, right? But now more than ever, there's a lot of craziness out there. We know that there's a lot of things that are overvalued. But this just, goes to show you that all it takes is one company to come bring things down. What's important to make sure of is that you don't get too emotional and too scared, and then you start selling, because in today's market, we could be down 600 points today and 600 points up tomorrow. Right. So it's important that, we talked previously about, volatility and market risk is, I don't think everybody should be all invested in the market, especially as you're approaching retirement, being in retirement. But to the 401k point, there are a lot of, funds nowadays that are heavily weighted in the tech market, if you will. Mm-hmm. So what's important, and this is what we do for a lot of folks, is we ask them to bring in their 401k statements or whatever they have, and let's take a look at the fund, see if this is something that kind of aligns with their strategies. Because one of the worst things that we see is that there's a lot of people that could potentially have, 3 or 4 different accounts, and all of their funds are all in the same thing. Right. So if all of your money is doing the same thing, invested in the same spot, what are you really accomplishing at that point? So diversification is key. But, the market volatility is always going to be there, whether it's the NASDAQ, whether it's the Dow Jones or the S&P 500. There's going to be some volatility.
I would say that 99.9% of the people that are listening and come into the office, if I ask them, all right, what kind of investments are you holding within your 401k? And they would say, well, I got this mutual fund, I got that. I said, that's true. That's the investment. But what are the holdings within that mutual fund? Nobody knows that. I mean, do you, Chris? I mean, have you ever sat down and looked at your statement and going back and saying, well, they own NVIDIA here, they own NVIDIA there, they own IBM? I mean,
honestly,
most
no.
people.
No.
Correct. So that's when you start looking at diversification is how much do each of these mutual funds have in the same stock? Because if you own 10% in NVIDIA and 4 of your accounts, guess what? That might mean that you have about 40% in one stock.
Mm-hmm.
Is that a good strategy? No. So, I mean, that's the thing that I would say to most people is that your statement is not your investment plan. It's just showing what you have. What is it worth? Now, who's going to know whether or not you have the right diversification unless you sit down and talk to a fiduciary that can go through some of this? But the other thing is, if you have everything in one stock market is very emotional for 90% of the time. They might hear something that might go very positive, and next thing you know, that stock might go up 50% today. And then tomorrow, all of a sudden, they hear something negative and it might go down another 25 or 30%. So where are you? So you're riding the emotional roller coaster of investing. When you're in retirement, that's not a good place to be. You kind of want to have some, let's just say, safety that you don't have to worry about all these things every time. Should you have everything in the market? Probably not as you're nearing retirement or in retirement, but you need to have a second opinion of where you are. Is it doing what you want it to do? And it depends on what you're trying to do.
Yeah, and not just the diversification of the funds and see what holdings are in there, but also the fees. And a lot of folks don't realize how many fees they're actually paying inside their retirement accounts, 401ks, TSP, whatever. But, we take a look at, last week was the deep seek. This week was the tariff talk. I mean, there's always going to be something that's going to drive the market up or down emotionally. So that's why we always kind of refer back to, let's take a look at what you're currently doing. Let's see what your time horizon is. Let's see how far away you are for retirement. See what you need to fund your lifestyle. And then maybe we can, play a little bit, invest a little bit more on the other side. But that's what's the most important is what your plan needs to fund your lifestyle. And there's a lot of folks around here that don't know that number. So, you said the B word earlier, the budget. Yeah, there's a lot of people that don't know their budget. So that's one of the things that we do when we build the retirement roadmap is let's take a look at the fees that you're spending. Let's see where you currently are as far as investments, and then let's kind of take it from there.
Having that customized plan, that retirement roadmap, and to see how it all works together is as simple as reaching out and setting up a time to speak with the team at Welcome Home Financial Partners right now, 804-635-3550. Once again, it's 804-635-3550, or going online to the website, welcomehomefp.com. If you don't know, how you're allocated right now. Ralph, you mentioned people who aren't opening it out of fear for what it might be doing. It doesn't mean that it's still not happening behind the scenes. You just don't know. And if there are chances to course correct or actually get true diversification, I think it's something that people should probably take advantage of sooner rather than later before it does become a bigger issue. Your 401ks turn into 201ks, or 50ks or what have you. Reach out again, set up a time, 804-635-3550, or online, welcomehomefp.com. And as always, we appreciate you joining us here on Aspire to Retire with Ralph and Tim Short of Welcome Home Financial Partners. Hope you have a great week ahead of you. Hope you, if you watch the game, hope you enjoy whoever you're rooting for. Maybe it's just the commercials. Enjoy that. Gentlemen, always a pleasure. Appreciate you taking the time to spend with the listeners. And as we wrap up, I want to leave you with the final word.
Thank you, Chris. And who's doing halftime show? Is it Kendrick Lamar?
Kendrick, yeah.
Yeah. Okay. So that's better than Taylor Swift. But anyway, we appreciate everybody listening. Everybody enjoy the game. I know I probably won't. I might just enjoy the commercials in halftime. But, we talked a lot about, different things with retirement. If you want a second opinion or if you want to see that you're on track or not, if you just want to meet us in an informal setting, the first Fridays are a perfect time to meet us at one of the offices. But visit our website, give us a call. We love the opportunity to sit down with you in the office and see kind of where you're at and see where you want to be. So once again, take care.
All content is for information purposes only. It is not intended to provide any tax or legal advice or provide the basis for any financial decision, nor is it intended to be a projection of current or future performance or indication or future results. Opinions expressed herein are solely those of Welcome Home Financial Partners and Welcome Home Wealth Advisors, LLC. The information contained in this material has been derived from sources believed to be reliable, but is not guaranteed as to accuracy and completeness and does not purport to a complete analysis of the materials discussed. All information and ideas should be discussed in detail with your individual advisor prior to the implementation. Each individual investor's situation is different, and any ideas provided may not be appropriate for your particular circumstance. Advisor services are offered by Welcome Home Wealth Advisors, LLC, a registered investment advisor in the state of Virginia. Being registered as an investment advisor does not imply a certain level of skill or training. Insurance products and services are offered through WPI Holding, Virginia Insurance License Number 138509, an affiliated company. The information contained herein should in no way be construed or interpreted as a solicitation to sell or offer to sell advisory services to any resident of any state other than the state of Virginia or where otherwise legally permitted. Welcome Home Wealth Advisors, LLC, and Welcome Home Financial Partners are not affiliated with or endorsed by the Social Security Administration or any government agency.